So we just completed horizontal analysis. Now we're going to look at vertical analysis, and as the name implies, it goes up and down instead of across the horizon. This is objective 13.2. So the way you do vertical analysis is each item is a percent of revenue. So 63,700 divided by itself is 100%. 19,570 cost of goods sold divided by 63,700 is 31%. All the way down, we take net income of 5,560. So 9% equals net income of 5,560 divided by 63,700. All right, and all that information together can be somewhat informative. It's much more informative, as we'll see in a little bit, when you compare it to peer or possibly to itself through time. So let's look. We have cost of goods sold 31%, so less than a third of your revenues eaten up by cost of goods sold, and a gross profit of 69%. Now, while you would want to compare this to industry peer, in general, this would be an excellent gross profit percentage, is 69%. Now, selling and general administrative, this is very large, is 51% of revenue. So your operating income is only left with 19%. For some reason, they have just no debt, very little interest expense. Income taxes are 20% of revenue. And income tax, or income before taxes, ends up being 20% of revenue. And net income to service revenue is 9%. So you're retaining 9% of your revenue as income. And that is an okay number. Okay, just in general. But once again, if you're in a specific industry and you have a specific history of this firm and its competitors, this analysis becomes very much more useful. All right. So here's vertical analysis on the balance sheet. On the income statement, it was as percent of revenue. Here it says percent of assets. So if you see total assets is 100%, and every single item in the assets is divided by total assets, and the same thing for all the liabilities and stockholders' equity accounts. Okay. Let's see, what can we say here? With vertical analysis, it's a little bit like ratio analysis. If 47% are total current assets and 21% roughly are total current liabilities, you know that your current assets your current ratio is going to be pretty high. Your total liabilities are 86%, so this is a high debt ratio. It's a highly levered company. You have total stockholders' equity of only 14%. So it's once again, it's a highly levered company. Even though this is, let's see, you have AR and inventory, looks like a retail operation or a manufacturing operation. It is levered almost like a bank. So I think this company, let's see, seems to have a lot of debt, even though their times interest earned ratio is good. Okay. I mentioned, so what are we going to do? You look at the ratios and you apply a little common sense. Current assets 47%, current liabilities 21%. They seem to be in a good liquidity position. But they do seem highly levered. Okay. All right, so common size financial statements, it's vertical analysis with only the percentages. So instead of having the actual income statement dollar amounts, all you have is percentages, and you use it to compare two companies. So over on the left, the cost of goods sold, looks a little better, and their gross profit looks a little better. Their selling general administrative expenses lower, so their operating income is higher. Their income before taxes is higher. Their net income is higher. So These small changes in cost of goods sold up here and selling general administrative expense really are amplified down in net income. So this, is clearly the superior company here, but it doesn't necessarily tell the whole story. If this company is much smaller than Hampton, they may be a takeover candidate. They might want to gobble that company up, maybe even to acquire the management team, which is clearly doing something right. If they're about the same size, Hampton, unless they change their strategy, may continue to lose market share. In particular, Hampton has to do something about these higher overhead costs right there. So those are costs that aren't necessarily benefiting the consumer or the customer. All right. Analyzing the statement of cash flows. Now we have a different company, Genie Marketing. And I'll tell you what, let's take a little break on the video and come back to this cash flow statement.